If you've been in the business of trading for a while, you've no doubt not only jumped your trading system and your strategy, but also your market. Netpicks, we offer trading strategies that makes approaching different markets really easy. In the right hands, it allows traders to find markets they're comfortable with. But in the wrong hands, it allows people to jump ship during different market conditions. So what usually happens? Well, the futures market or the Forex pair or the stocks that you've been focused on, they start to make a move. But the problem is you left that market and you're missing the breakouts that are now occurring. And it doesn't even have to be that dramatic. Trading the mini Russell a couple of days a week while looking at Forex the rest of the time, even that's a recipe for disaster. And that's something you've probably done or you're still doing. Now keep in mind that we have a system that puts our odds in our favor. And the only way that we can take advantage of those odds is to take the trades consistently in a given market according to a detailed trade plan. And that trade plan that you put together for that market and that instrument, it should have been based on back testing and then forward testing your trading strategy. Done right, this can be time consuming, but it's what Troy here at Netpicks calls ditch digging. Once you dig that ditch, you're ready to put in the foundation that should help sustain you throughout your trading career. Cherry picking trades on different days or in different markets is never going to lead to consistent results. You're going to find yourself missing out on the winning trades and catching every single loser. Don't let a minor losing streak cause you to lose confidence in your system. Now, if we're sticking to our guideline of choosing the right markets, choosing the right time frames, then over an extended number of trades, the odds are going to play out in our favor. Now, marketing for diamonds, maybe diamonds are forever. But does that hold true for a market? Now, while jumping from instrument to instrument every week is not a good practice, is there ever a time that you should consider jumping the fence for greener trading pastures? Look, we don't want to force a market and a time frame to work when that system is working well on other different markets. The key is to keep a record of your trades on a daily basis in a journal. At the end of the month, go back, review the results for your given market. You then have the opportunity to analyze whether or not the results are satisfactory. If you find that the market really seems to be slowing down, then maybe this is the time to consider moving on to another market. Now notice, I'm not recommending you do this every week. Markets are going to have down days or even down weeks from time to time. But it doesn't mean the market's broken. If we start to see an extended drawdown, then you know it's time to move on to something else. Bonds, for example, used to be a favorite trading vehicle for us at Netpicks. When the volatility began to fall, they were pushed to the back of the line. And I don't want to force these markets to work when other markets like currencies, for example, or crude oil are working even better. And all you have to do is create a trade plan for one of the other markets and just make that change. But you don't want to simply copy an existing trading plan. Markets have personalities and they trade differently. Sometimes you're able to plug and play your current system, but if the rhythm of the market is really different, you got to dig your ditch. So here are 5 points that you should consider before you switch markets. Number 1, consider your winning percentage and your profit factor at the end of each month. If your performance is taking a hit over an extended period of time, consider taking your game to another market. At Netpicks, we want to see a 2/3 win rate. However, profit factor for us is really the main driver. Number 2, is the trade profile shrinking? Markets have a rhythm, and when it starts to break down, you'll see that in the trading opportunities not having a large enough range. An example in the Forex market could be 100 pips that were common, and now you're looking at 50 pip trades. Number 3, forward test other markets and simply just track them. If your tracked markets are beginning to outperform the markets you are actively trading, maybe it's time to dedicate some of your trading account to the movers. Number 4, losing streaks happen. Off the time, you're going to have runs where you feel like a win is never going to come. But your back testing should have highlighted expected losing streaks. But if your drawdown is extending, maybe consider moving on. Number 5, are you switching markets out of frustration or statistics? Trading can be emotional. And if you are allowing your emotions instead of hard data to force your moves, you're on the wrong track. Proper logging of trades is where you should focus in order to ensure that you're switching markets, it's done for the right reasons. And the best traders that I know are aware of the markets that fit their trading style. They specialize in a handful of markets, which allows them to master the art of trading in those markets. Don't panic when you hit a losing streak, but at the same time, don't be afraid to give up a market that you've always traded if you find other markets to be producing a lot better results.